businesses just like yours grow. So my name is Elise Hatton. I manage with my team. I'm fortunate enough to manage the Smart Hub, and I'm also fortunate enough to introduce our incredible speaker today. So as you would have seen on the marketing, it says there that most businesses go broke not because they're not profitable, but because they run out of cash. So cash flow is very, very important, and finance as a whole is one of the most important aspects of running a business and being able to be in business for a long time, which I'm sure we're all looking to do. And so our topic for today is the fundamental of business finance, and we have David French from the Investment Collective delivering today's session. David has just been, you could read his background on the marketing, but David was just saying he started with one desk and himself. He now employs 42 people across Rocky, Sydney, Melbourne. He's developed incredibly sophisticated software to run his business, and he has 700 million under management. So very, very impressive, a long background and a long history, and an experienced person to talk to us today about finance. So thank you so much for your time, David, and we look forward to hearing what you have to say.
Thank you so much. Is one of these a pointer thing, or am I using my finger?
There's no pointer, but it does switch through the slides.
Oh, does it?
So,
Okay.
yeah, so you can use it for that. Yeah.
Half is good. How many isn't going to be about how to raise money and how the disciplines you need to build our business from scratch, from just me and a desk, to we have regulatory requirements, we have capital requirements that have all got to be dealt with, and as you get bigger, there's a whole raft of things that you've got to take into account that don't or aren't necessarily related, probably aren't related at all, to your main passion. And my passion is helping people with their finances, whether that's finance in business or whether that's finance personally. And I guess for the people here that are involved in startups, your passion would be software development and getting your software to do things that you want it to do, I assume, to improve society, or at least to improve the lives of those that are going to purchase your software. Or maybe you just want the money. Either way, you've still got to make your business run properly. So I'm going to go through some basic things that everyone in business needs to know, and I'm going to put it out there for any government people watching that I think from now on we need a license for people to go into business, because there is just too many small businesses that go broke, and they go broke from fundamental errors, and when they go broke, they don't only hurt themselves, they help hurt all the other people that they dealt with. So, there's a responsibility in running your business that is over and above the responsibility to yourself. When you run a business, you're engaging in society. That means other people are interacting with you, and if you hurt the other people, then, that's a blot on your copybook. It's also going to hurt yourself. So I want to help you prevent that. So let's get started. I'm just going to go through a few really common errors in businesses. Any business, or any startup, or any business at all, really. The first error in starting up a business is not being well capitalised. So that means not having enough money to get going or to stay in business. Now that's a critical thing, and the issue behind it isn't only what you need to pay yourself, but what you might have to pay for licensing fees, for input costs, for employing someone to help you perhaps. These things all need to be considered up front and not dealt with on the fly. If you don't consider these up front, you're not doing your job. There is any number of startup stories where they've got this great idea and they progress down the track for 80%, and then they find that they haven't got the last $20,000 or $100,000 or whatever it is to finish this thing and get it off to the market, or at least get it up to a level where someone might get interested in distributing, or co-branding it, or something like that to get you broad exposure out into the market. Well, if you've done 80% and you can't cross that last hurdle, you may well have done nothing. So I'm just going to mention 3 ways that you can get money for your startup. Right? They're very broad. There's no sophistication in this, and they've all got different pros and cons. So the first one is gifts. Now, we were just talking a minute ago about angel investors. Well, I'm not an angel. I think I've got 666 tattooed on me, but so I have some trouble with this angel investor concept. Regarding the effect on it is it increases your ownership, because you're getting money. Someone else has just given money to you to spend how you see fit. So you're not having to go and compromise your level of ownership by bringing in other investors or borrowing from the bank. Is equity, which is basically issuing shares or units or some ownership component. Now, an equity investor always expects a return, but under law there's no obligation to pay an equity investor. You know, an equity investor puts money in and then they take their chances. Now, there's a whole bunch of rules around that, of course. You can't just steal the money, but that then has got a reduced level of risk in it, because you're bringing in other investors, but there's no obligation to pay them back. If you go broke, or if you tight cash flow, no one's going to bang on the door and say you must pay me. They can't. That's not the nature of equity. The issue with equity, though, is it reduces your ownership, because each time you sell some part of your company or business endeavour, so you're selling part of your company or business endeavour in return for this person putting in funds. So that means it's going to reduce your ownership. The next thing, the last one there in this, is bank debt. Now, you can go to the bank and more than one person's funded themselves on credit cards, which is another sort of bank debt. But there is an obligation to pay that back, and there's an obligation to pay interest. So that increases your risk, because if the bank ends up not liking what you're doing, they can just come and say, I don't like what you're doing, I want my money now. So that all comes down, as you get bigger, that comes down to how your loan covenants are set up and how flexible the bank's likely to be. But it does have, so that increases your risk, but it also has the opportunity to increase or at least preserve the level of ownership, because in a bank arrangement with the bank, you're not giving any part of the ownership of the company away, you're just borrowing money. Okay? So the risk is that the bank says, I want my money back. The benefit is that you're able to keep the whole company, and if you can keep it running, then the bank hasn't got any say on the equity, so all the returns accrue to you. So in this one, all the returns accrue to you. In equity, all the returns don't accrue to you because you're sharing with other equity holders, and in bank, all the returns accrue to you. So, the things that a small business person needs to think about is it better to own something, 10% of something safe-ish, or 100% of something risky? And depending on how you fund your business, you can determine the level of risk. Now, I don't own 100% of our business. In fact, I don't even own 20% of it these days. And I think I've taken the view that I would rather have 10% of something safe that can roll with the punches, whatever's thrown at us, because it's largely equity funded, than to be in a position where something happens that is out of my control and the bank comes and says, I want my money back, which may well make us shut. And I have been through that experience, so I'm speaking. That's not a theoretical throwaway line. That's something I've been through, and you don't want to go there. It's not only the setup costs, as I indicated before, that you have to think about. So this is all about how to fund your business, right? So you've got to come up with a number that's going to take to fund your business, and you need to use debt equity, or your choices are debt equity or an angel investor.
So angel is equity investment.
Oh,
it's just early stage. Just before
okay, so when I've read about Angel, it's been like,
no,
I'm just going to give you some cash, have a nice life.
So I
don't see that happen very often.
No, I think they call that the 3 Fs: family, friends, and fools.
Right.
Yeah.
Okay. Fair enough.
So it's after that.
Okay. Right. So, so you might find someone that's prepared to gift you something, and it's not normal. But whatever, they're the choices. So someone might just give you some money and say, have a nice life. I don't think that's likely, but might happen. And then there's equity or debt. They're the only ways that the business can be funded. You need to come up with a number that it's going to take to fund your business, taking into account all these things that might be thrown at you. So whether it's staffing or your own salary is something that no one ever writes down. Like, how much does it cost you to eat? There is a number, and you need to be able to put that aside so that you can fund yourself for the duration of the program until you get your app, if you like, or whatever you're developing out into the market. So you need that number, and then you can fund it. And you've got to remember, aside from normal expenses, you might think, and how many times does this happen? Oh, it's going to take me 9 months to build this app. It won't. It'll take you 18 or 2 years. You make sure you're ready for that. Because the name of the game is to stay in the game. You don't want to be forced to leave the table before you're finished. Because once you're not at the table anymore, you're out. You've got to start again. So make sure whatever mechanisms you use, you put the effort into finding sufficient funding. So that's problem one. Not enough thought up front is given to those things. Error two is running out of cash. Now, not being well capitalised is one way to run out of cash, but there's plenty of others. So most businesses, and this is a fact, if you go and do any formal corporate finance sort of subject, you'll find that most businesses don't go out of business because they don't make a profit. They go broke because they run out of cash. Now let me just look at this. So here's a business that's got $100, 1,000, million, whatever you want, in sales, 60 in salaries and super, rent 5, depreciation 5, insurance 2, travel 2. When you add that up, 74. They've pulled in 100. They're running down the street and saying, happy days, I made 26, right? But, and this happens all the time, okay? But what if, of that 26, of that 100, only 60 was collected in this particular month, right? And 40 was on the books as a receivable, so it was owed but not collected. Then that means, and this is converting, if you like, profit numbers to cash flow numbers, and cash is all that matters, okay? Cash is all that matters. So you end up with a situation where you got 60, you thought you had 100, but actually you only had 60 because this is still owed to you, right? Salaries are 60, which is the same, that's not changing, because you end of the month, you're already up for that. Rent, same thing, you're already up for that. Depreciation you can leave off because it's not a cash item. So depreciation is basically an allowance to replace capital or an investment that's already been made. It's not a cash thing, it's an accounting thing, so you can take that off. Insurance doesn't change, and neither, let's say you have to travel to go to conferences and keep up your knowledge and all that won't change either. So the total costs drop from 74 to 69 because we're not counting depreciation, it's not a cash cost. But your sales, the money you actually collected is only 60. So you thought you had 26, but you take 69 from 60, you're actually underwater by 9. So that was it. You're telling all your friends this was a great month. But actually, you're paddling like a duck. You look all tame on the top, or confident on the top, but underneath you're paddling like hell because you're going broke. That happens every day. Like 3/4 of the businesses in this town are dealing with that. Don't do it. And as our Chief Financial Officer says, nothing goes faster than cash, which I think is actually a nice throwaway line. So error number 3 is falling in love with something and not killing bad projects quickly. So in economics, this is called essentially a sunk cost. You spend some money, or you take a position on something, and you don't move from that position because you fall in love with it. You don't look at it with a professional mindset, if you like. You just say, this is so good, I'm just going to do it. You keep throwing money away, even though there's that little voice in your head that's saying, I don't think this is going anywhere. You know, you've got to be very mindful. I mean, there's a whole range of literature around mindfulness these days. And mindfulness applies to business. You've got to have your mind switched on. You've got to be thinking about things. You don't drift along. You say every day, am I doing the right thing with this project? Is it going in the direction I thought it would be going? Is it costing about what I thought it would cost to develop it? Is it taking me about the right amount of time? Because all of those things are eating away at your ability to fund it and your ability to get a reward at the end. So you've got to be very clear with yourself and honest with yourself. You can only do that if you're thinking about it. The other thing is, and this is in economics and finance called the opportunity cost, it might also be falling in love and pushing along with something that's really a dead duck. Might be costing you in other ways, like that time and effort. You might have 3 good ideas, but just because you fell in love with one, you need to, if it's not going anywhere, you need to can it and go with one of the other 3 that's good. Not keep. So that money might. So any questions about that? Message across. Cash is king. Make sure you're funded properly, and don't go blowing money on lost causes.
I have a quick question. So when do you know that you're just not persevering enough versus this is not going anywhere?
When you're, well, I'll speak from my own experience, you've got an idea about how you want this business to, the train tracks it's supposed to be going along. And, you know, I'm not saying that being in your business is not creative. Like the train tracks aren't as formal as train tracks, I guess, but so there's always going to be deviations and unexpected things, and you've got to deal with them. That's business. But if you've got to build a whole new railway line out here to achieve what you're going to do here, then that's probably a signal that, hang on, I probably didn't get the scope of this right. And that's a time to really reassess and to say, you know, am I moving along more or less in the way that I thought I was moving along, or have I got to take this great big detour that's going to cost me thousands and thousands of dollars to achieve what I wanted to achieve? Now, sometimes it's worth doing the detour, but that's the mindful thing. You've got to sit there and think, okay, I get this. It's bigger than I thought it was going to be. Am I really doing what I thought I was going to do, or is this a whole new project and I really just should be doing something else? Now, I've just gone through a few little things. So I've formally called this common, legal and very bad, but because of my age I couldn't help put up the good, the bad and the ugly, which is, for younger people, it's a famous Western movie. Very well worthwhile watching. So these are just things that we see every day in our business that are not talked about out there, and there's, well, with a couple of exceptions, there's no legislation around it. But if you don't do these things, you are almost certainly going to go broke. I promise you, that's a guarantee. That's just not me wishing. That pretty much comes with a cast iron guarantee that you will go broke if you don't have these disciplines. First one is not having a formal budget. Now, I can remember writing my first budget up when I was about 18, right? And I just realised, I realise now that I didn't know anything. They were just numbers on a page. I had no intention of doing anything on that page. I was just putting, and well, back then, if I only spend $20 a week and I'm earning $100 a week, that was my first share. First Friday night, that was all out the window. So that wasn't a budget at all, that was just silly, you know. But I have had the advantage of working under some people who really knew about budgeting, and they taught me what a budget really was. And all a budget is converting these ideas that you have for your business into some numbers. That's all it is. So It's not a straitjacket, it's a plan. It's just a plan described in numbers instead of words. Now, a lot of people go, oh, I don't like the numbers, or I'd rather be coding, or I don't want to write anything down. But you owe it to yourself to go through these things, and because going through these processes help you clarify in your mind, they help you think and understand what your business is really about and how to make it work. So, for what I do is I doodle. I get a rough piece of paper. I've always found for more complex things a piece of graph paper is good, but I just scribble on it, just free form, and draw things up in a pattern or whatever. Or sometimes I just sit on the back deck with a beer, and think, I wonder how that actually looks. But you just don't go and have another beer, then you jot it down, right? Then put your numbers into Excel. So if you thought you were going to earn 100, put that in Excel, and then you've got the costs around that, put that in Excel, and then put some words into Word, or whatever, I guess you're all in the cloud. But whatever it is, write it down. So here's your story in numbers, here's your story in words. And if you go to that trouble, you will start getting your thinking processes so much clearer, and you will stop worrying about what's going to happen tomorrow, because this sort of stuff will start looking after itself. If you're clear about that and you've got your financing right, well, this will help you get your financing right, then you'll stop worrying about how I'm going to survive tomorrow. You will be able to concentrate on your programming, or your, whatever we call building apps these days. So, if you do that, suddenly you've got a budget and a business plan. And with a budget and a business plan, you can go to the bank and say, can I have some money? Or you can go to an equity investor, an angel investor, and say, can I have some money? And you know what they'll say? They'll say, wow, you're about 1 in 20 people that I meet that actually has gone to the trouble of writing a budget and a business plan. They will listen to you. We get people every week there'll be someone coming into work saying, I want some money for something or other. And almost always it's just an idea. But this brings an idea into something that financial people can start respecting. And if they respect you, they might open the checkbook. Now this next one is illegal, right? And there is a stack of it about. People in small business think, if you've got employees, or even if you're employing yourself, if you've got a formal arrangement where you're employing yourself, maybe you've got a company set up that's doing app development or whatever, and you're paying yourself through that company, you have to pay superannuation. This is not a discretionary spend. It's illegal not to pay superannuation. But there would be, I'm going to say, 30% of businesses in this town that don't pay their super. They think it's discretionary. And they come to us when they're going broke and they say, please fix me. And you know what? If you've got your tax up to date and your super up to date and a plan, then the corporations law gives you a whole heap of exemptions that say, I'm not going to send you to jail. They say, if you've got your other things up to date and you've got a plan and an advisor, and if you've got your super up to date, your tax up to date, and you've got a plan and an advisor, then we will help you work through to make your business survive. If you haven't got that, they'll just say, oh, well, criminal breach, see you in the big house. So there's lots of reasons to do this. And another thing is not getting your returns into Australian Companies Securities and Investments Commission. So if you have a company, or if you're a business and you've got to send something back to fair trading, then these things need to be done. They're not discretionary. These are obligations on running a business. So and for some of these things, if you don't do them, you will face personal liability. And if you build up equity in your app and you haven't paid your staff super, or you've been earning money on your app and you haven't been paying tax, what asset do you think they're going to go for to try and sell? They're going to go for the very thing that you've spent your whole life building. Because, it's probably all you've got at that age, or that stage in your career. So don't risk it. And also, I would say, what does it say about you as a business person? If you can't do these fundamental things. Now, this is not going to send you to jail, but it probably will send you broke. if you don't do it, and so I've called it very bad. And it's really not keeping your books and financial records. And the thing that we see all the time, and or anyone that's passionate about their game, right? The rural community is a great example. I love farming, I love making things grow. Developers, same thing. It's like I just want to spend my time, in the code. So all these other peripheral, these things about running a business and the financing of business and all that are considered to be peripheral to the main game. And because of that, too many businesses think that bookkeeping means dumping the numbers. They jump to a conclusion that it means bookkeeping means dumping the numbers into an accounting package, like Xero or Reckon or Mile. But and then they just forget about it. I threw the numbers in. Yeah, have you done your books? Oh yeah, I've done my books. But the books only matter if the numbers have been entered. The books are only useful if the numbers have been entered correctly and according to a pattern. So if one week you've got travel in one category and the next week's in another category, you're supposed to compare what happened week to week or month to month. You have to be consistent with this. You've got to be disciplined about how you keep these records. Now, it's not even difficult to do. You've just got to decide to do it. And you can get someone to help you. I mean, we've got a bookkeeping offering at our work, but there's dozens of bookkeeping people around. You don't have to use us, heaps. Or you can get interested a little bit yourself. And when you're small, it's probably a good idea to get interested enough to understand it. Because then if you understand it at least a little bit, then you can talk to people with some authority and say, I want my book set up like this because that reflects my business. Then the next thing you should do is when you're doing this, set up your books or set up your budget, however you want to look at it, the same. So your categories are the same. So you can say, I've got staffing or wages, I've got travel, I've got subscriptions I have to pay for, or whatever it is. And keep those categories the same in QuickBooks or in your bookkeeping package, the same as you've got in your budget. Then you can compare them. You can say, what did I think when I set up this budget each year? What did I think was going to happen? Am I close to that? Or is something really blowing out of the water that I had really no idea what we were going to spend on it? So if you do that and you do it in a disciplined way, you'll have a management tool, again, that again will reward you in spades because you won't be guessing. You will have sat at the beginning of the year or month or whatever it is, the period that you're budgeting for or managing to, and you will have said, this is what I expect to happen, what actually did happen. And then you can start making some adjustments. Say, okay, well, I need to cut my spending, or I need to get some extra revenue in, or whatever it is. It's an indispensable management tool. So this is just a simple example of how that might look. So you've got, again, a budget and actual. This is just for the month of July, and I set up, so I'm a developer of apps, right? I thought that I'd get 30 in revenue. Actually only got 25, it's down 5. Why? You don't just stop there. You move into there and you write it down. It's best to have it tabled out like something like this. You can do it easily in Excel. You don't have to have a great war and peace story. You just have to say, why was it down? Was it down because I got higher, I'm expecting higher sales in, someone came along that I thought was going to buy something in July, but actually it's not landing till August? Or is it that actually everyone hates my product? What is it? So ask yourself these questions. I've been selling my programming time. So outsourcing, I've been using my time on, I forget the name, one of those outsourcing, sorry, did I get that? I've been expecting to sell my programming time. I was going to sell $10,000 worth or $10 worth of programming time in July to external people just to keep the cash flow going in. Only got 8. I have people that are buying some version of my app on a subscription basis. I thought I'd get 5, but that's going gangbusters. It's actually going really well. I've got 9. So why? Why are these things happening? And once you start getting these patterns, you might find that subscriptions is the way to go. You might find that you're wasting your time on all this effort up here. It might be far better to have something you set up on a subscription service so that more and more people are paying you a smaller amount of money than a few people paying you big leagues. Does that make sense? Then, you know, the salaries and super, same thing. Ask why. Why were you two over? You thought it was going to be 20, it ended up being 22, you're 2 over. Why? Rent's unlikely to change because you should know that out in time. Depreciation's probably not going to change. Insurance, you thought it was going to be 1 and ended up in 2, you know. Is the game you're in a much higher risk activity? You know, are we selling, or is there a risk that you'll be sued for the type of software you're developing because you're going into some sort of risky endeavour? Maybe you're selling it to the Navy or the Armed Forces or something, and someone thinks you're going to be subject to a cyber attack. You know, like they're real things. You know, maybe you just misjudged because you didn't see that aspect of the business that you're developing. You know, travel. Spent 1.5, you know, was that just, you know, you see this all the time, small businesses, travel budgets planning out. Oh, where'd you go? Oh, you know, well, I had to go to New York and I had to go to Rome, you know, to go and look at dresses to stock the shop. Well, what sort of shop? Oh, it's a beachwear shop, you know. Well, now, was that a holiday? You know, are you just using work money to fund a bit of, you know, a bit of entertainment? So, you know, write this down and be honest about it. So, you know, here you can see that in this case, we ended up, if you take the expected income from the total, we thought that we were going to have 19 profit. But actually we only got 9. So we're 10 below. And these are all only little things, but they add up. So you've lost over half of what you thought you were going to have because some of these judgments were incorrect. Now, some of them might fix themselves up as the months go by. It might be just timing month to month. But some of them might be endemic to issues that you need to address in your business. So I was going to end up with a little exercise, just so everyone is awake, and then I'll field any questions that they like. But, you know, I said way back here about the running out of cash, confusing profit with cash. So you might not have, you know, you've got 100 you're expecting, but you only collect 60 and 40 is still owed to you. The other side of that is you might be underwater with one way to fund this discrepancy of cash is not to pay some of your suppliers. So it's hard to do in this, but let's say that you know, let's say that there were subscriptions in here that you needed to run your business, right? So you think, oh, I'm just not going to pay Microsoft for, you know, this month. That'll give me a bit of extra cash so I can pay the things I really have to pay this month. So you might not get money in because it was owed, but you just haven't collected it, which is that first chart I was showing you. Or you might be short of cash, right, and you're funded by not paying someone. Now, that happens all the time. And before you know it, you'll be in trouble. So in this last page, I don't know who's got a pen, but probably help if you've got a pen. Or you can do it in pen. This top panel is basically actual information, actual data that comes in over a 6-month period for a business. Okay? And it's just saying the profit and loss, here's what's happening. And in every month you can see that the profit and loss says you're making $6,000 or $6 or whatever you want to call it. Okay? But this bottom panel is adjusting this for cash flow issues and surprises. So what I want you to do is help me work out where you sit at the end of 6 months if you don't do anything or if you don't act quickly. So what I'm saying is in the first month, you ended up, you didn't get all your bills out, so they still owed you 15. Same as this back here. Oops. Same as that there. See that receivable, that would be 15. Okay? So you didn't get all your bills out. You're expecting 49, but you didn't collect 15 of it. So see the 49 at the top there. You didn't collect 15 of it. So there's 15 that you're owed, but it's cash you didn't get in. So then you said, okay, I know how I'm going to deal with that. I'm just not going to pay some suppliers for 15. So that's square. So that month you think, I'm okay now. I found 15 because I didn't pay my rates or whatever, didn't pay my bills. You get it?
Yep.
So you're all right for 1 month, and you might be all right for 1 month. But the next month, the same thing happens. And you're too busy to get your invoices out, and you haven't done any budgeting and cash flow stuff, so you're just thinking, oh, bloody hell, business is hard, I really hate this, I just want to get back to my programming. So that happens again in the 3rd month, and again in the 4th month, in the 5th month, and in the 6th month, happens again, but also, and this is a little trick, a trap that people get into, in fact, half the economy gets into it. If you're paying fortnightly salaries, there's going to be 2 months where there's 3 pays. Now you've got to remember that, because if you budgeted for 2 pays every month, and suddenly you get a bonus, a scary bonus pay due, you're going to find that money. And so this person wasn't careful and suddenly has 10 that they have to pay as well in June because they didn't think carefully about how the payroll works. Yeah. So what I would like you to do is add up acrossways each of those, most of you, I'm sure that you can all do it in your head, and just write down the totals in those 3 little, those 3 cells there, and then we'll just add up. Add up the total of the 3 cells.
Yeah.
So really all you have to do is 6 times 15, and then 6 times 15, and then add 10. So what's the answer for the first line? Sorry? 90. And what's the answer for the second line? 90. And then third one? 10. So you add all them up, what's that? So this started off as a $15,000 problem that you patched up because that you fixed by not paying some suppliers. What did it end up about? It ended up a $100,000 problem. Do you think it's going to be difficult to cover from a $100,000 problem as opposed to nipping it in the bud right at the very beginning? This happens every day. Time and cash go so quick that people just try and put a little band-aid on it, and the months go by, and before you know it, you're ringing people like us to get you out of trouble. And mostly, the phone call comes too late. Because have a guess what the very first question I ask when someone calls up like this. Someone calls me up and says, David, I really should have called you earlier. This has been staring me in the face for 6 months. There's a lot of really good things about my business, but I'm in financial trouble. What's the very first thing I say? I'll give you a hint. It's not a moral admonishment or anything like that.
How much debt?
No.
Why didn't you call 6 months earlier?
Sorry.
Why didn't you call 6 months
That. Well, I normally try and not say that, but what was it? Sorry, I'll put it another way. What would be the first thing I would ask for? And
business plan?
no. The bookkeeping, the data, the bookkeeping data. Because if I haven't got that, I can't even see where the business is. And then I have to go and build it from scratch. And a lot of accountants don't think your accountant's going to save you, because mostly they're looking so far in the rear view mirror. The latest, at the very best, the most recent accounts they will have done is for the year before last. At the very best. So you need up-to-date management data, and if I come in, you need to give that to me, and then I'll swing into action, and would have probably, in most cases, have a reasonable chance. You'd be amazed at how flexible people are at backing you as a business person if you've got a good data. You'll find your suppliers will enter into repayment agreements. You'll find, you might be able to do some interesting arrangements with staff. You can definitely do arrangements with the tax office and things like that. But if you haven't got any data, I can't even get the story started. And I can tell you that building it from scratch after the fact, it just takes too long. And normally you've got to close the doors, which is no fun at all. So that was just a little exercise in 6 months, which I suppose if someone says come to a party in 6 months, that seems a long time away. But I guess if you look at it from the other side, and it was a great party, and you look at it 6 months later, you think, oh God, that seems like yesterday. What a great time that was. So 6 months is nothing. It just whips through, and you need to just understand how quickly problems can build up if you're not disciplined. So with that, I hope that wasn't too much of a lecture. It wasn't intended to be, but these things are not difficult to do. And they can be the difference between you having a really nice life and a not very pleasant life at all. And if you have a nice life, part of that will be getting your apps developed, or undertaking whatever activities you're doing here at Smart Hub or wherever you're doing it. So you owe it to yourself to invest in what I call the infrastructure of business. That's what this is. Do a little bit of that. You don't have to devote a huge amount of time. Just devote some time to it. Do these things, and I'll guarantee you it will pay off. So thank you. I'm here for questions.
Do we have any questions?
Well, it's not something that was covered, but do you have any information on equity funding?
On how to do equity funding?
Yeah.
So I can, absolutely. So this isn't a question about when you write me a check, is it? This is a question about how this can work.
Yeah. I'm thinking of doing some equity funding for my startup.
So have you done homework on what? Sorry, I just want to get clear what you're asking me. Do you want me to tell you about some different ways that equity funding can be achieved?
So yeah, pretty much.
Right.
And I'm trying to get my head around type of shares, like your Class A, Class B, Class C shares.
Okay, that's a great question.
So I'm trying to get my head around it to see what type of shares to release and how to value the company in terms of the equity.
Okay, well, talking about how to value it's probably a topic for another day, because that is a big deal. But let's say you can come to a value. That gets back to that one of the slides I had up the front about equity, who owns it. So what you're doing is you're saying I'm going to fund my business by selling part of the business, and through that you're selling the rights, if you like, with it to share in some of the benefits of the business you develop. Now, in terms of raising equity, there's a whole bunch of rules around it, and so really that comes down to 3 ways that you can raise it. Now, the big headline way is very expensive, and that's to do what's called a disclosure document. And if you go and do it, so if it's a unit trust, that will be a product disclosure statement, and if it's a company, it will be a prospectus. Now, that's for really large licks of money, okay? And I'm guessing, well, I'd have to know your situation, but I'm guessing it probably doesn't apply. So when you go onto the ASIC website and you say, how do I raise money? There'll be all this stuff about disclosure statements, which is very, very expensive, but you don't need to be scared of it because there's other things you can do. And I will just say in passing that there's two levels of disclosure statements, and one is a bit less onerous than the other. The second thing, though, a common way to raise equity is a person, like the legal person, is allowed to raise $2 million from no more than 20 people in a 12-month period. And that $2 million, that doesn't include people, and there's a bit of grey around this, but to keep the story short, that doesn't include people that are closely associated with the business. So if you're the owner, or if you're the principal right now, and you've got a senior person that works with you, you wouldn't be included in the 20 people. So you can go out there and talk to 20 people, and family, friends, and fools. You can raise $20 million you can raise $2 million from people like that in any 12-month period. So it can't be any more than 20 people, can't be any more than $2 million, and it's got to be people that you would be speaking to about this opportunity just because they're interested. You can't go and spruik it, you can't go and advertise it. Then the next thing, which is relatively recent, is equity crowdfunding. So I'm sure you're all familiar with what crowdfunding is, but it's only recently that organisations have been able to issue equity in return for a crowdfunding contribution. And that would, I don't even think that would be 12 months old, but you can raise $10 million if you're set up correctly. You can raise 10 if you are prepared to keep proper accounts, which is nothing different to what I've been talking about here. Then you can raise $10 million in equity through crowdfunding. So we don't do that at the moment, but actually we're only discussing that in the management meeting. I think we'll look to getting that on our licence to be able to do it. But as far as I'm aware, there are 7 groups in Australia that are licensed to provide equity crowdfunding. So they're like the 3 main ways to raise money in a company. And I've used disclosures. I've personally done for our business disclosure documents and the 1220 rule. Does that help?
Yep.
Any other questions?
No, I'll just go through the class.
Classes of shares?
Classes of shares. I don't know, time just to expand on that a little bit.
Yes.
So I know with my company set up, I think I've got, as the director, I've got a class D shares that are components of dividend options and stuff like that.
So that really is just, so do you know what that is? Most companies, if you go and buy a share in Woolworths or BHP or something, it's an ordinary share. Just a bog standard share, and everyone with an ordinary share has got exactly the same entitlements. But particularly in small companies, you'll find that, that quite often they'll have different classes of shares, and those shares won't all rank equally. Some might be able to earn or be rewarded with dividends, but have no voting rights. Some might, you might have ordinary shares, that's where you start, but then you can modify that. So you can take away the voting rights from ordinary shares. Or you might, one company we dealt with recently had the owners of, the E-class shares or something were only entitled to a discretionary dividend. So they would only get a dividend if the directors said, okay, this year we're going to pay you a dividend, otherwise you're not entitled to one at all. So there's no hard and fast rules about what classes, you can have class AAX if you want, and it can have whatever rules you want. That's limited only by your imagination and by the practicalities of the situation. I mean, subject to the tax laws and being dealt with, and that things are compliant. But I will say that when I've seen people get too clever about this, it can come and bite you. Because there's one thing about ordinary shares that's brilliant. Everyone's equal. And when everyone's equal, then you can manage, you can manage the way people behave. I mean, first of all, subject to the requirements of the Corporations Act, but you can also manage how people behave external to that through, shareholders agreements or whatever you want to set up, different ways around that. But if you set up lots and lots of different classes of shares, and some are entitled to this and some are entitled to that, someone's got to manage that, someone's got to make the decisions about how these rules are applied, and before long it can get very, very messy. And it can be also difficult to undo tax-wise. So let's say that you get down the track, you thought that this was a great idea, so you've set up some class of shares that's got some entitlement, and then you realise 3 years down the track that that doesn't work anymore. Well, it might be very, very difficult to convert those shares into something else without incurring capital gains. And in a game like yours, if you're successful, essentially a zero investment, you didn't spend anything to create the software apart from these expenses that might or might not be capitalised. You didn't, no one. Well, what I'm saying is, if you sell the business, you might end up with a really big capital gain. You might not want to sell the business, but you might want to change the classes of shares around or something, and that might realise a capital gain in itself. So there can be unintended consequences of being too clever. Is that clear?
Yeah, no, that's fine. It's just, like being looking at class A or whatever.
Yeah, well,
Didn't know if that was like a specific.
It's not.
Or I sort of thought it was how you were saying, like it could be whatever you really want to make it up to be.
It's whatever someone wants to make it to be. As long as it complies with the tax laws, it's whatever. There's no consistency.
Any more questions?
One other one, which we get good and bad and ugly. So, I want money to the tax man. I was once told by a gentleman that with a company, the tax department is like the only institution that can come after a director's personal assets to get their tax debt. Is that?
No, that's not true. It depends. Well, I'll make two comments about it. First of all, if you've been running a business well and trying really hard and doing things right, the tax department's very unlikely to come and shut you down, even if you owe them money. We've done this for clients before. You can actually ring up the tax department and they've got an automated thing where you just push 3, 5, 6 or something and get yourself an extension. You don't even have to speak to someone. They offer extensions. They're a lot better people than you think. Like if you're playing the game. But if you're not playing the game, then they'll probably get cross. So then to your point, if any creditor can show that you breached your duties as a director, so if you're, this is a really important thing. If you're running a company, right, it's not you. So that's another thing we hear out in small business all the time. It's my money, my company, I can spend it how it's not. And don't get into the trap of putting all your personal expenses, like your trip to New York or even to the Strand, in your company. Your company is your company. And if your accountant's any good, they'll have to weed all that out anyway, so you'll just be paying extra tax fees. So keep them separate, that's the first thing. Under law, in any event, the company or the trust or whatever it is separate to you. It's a separate legal that's the terminology, it's a separate legal person to you. Your job as a director, or if there's several of you, the board, is to manage that company in the interests of shareholders, or formally in the interests of the company as a whole. Usually that comes down to shareholders. But it can also, breaching rules, like there's cases out there where breaching the law is just prima facie. You can't say I broke these rules to make the company survive. That doesn't make any sense. So you've got to run this entity as according to the rules of the tax office and everything else that you've got to do, whatever that is. If a creditor can show that you didn't do that, then your personal assets are at risk. Now, that's not an easy thing to show. And there's when you see, this, wealthy business person shafted everyone and then ran off and nothing ever happened to them. That's why no one could actually make the link between the breach of directors' duties and the way the company was run. But if that link can be made, and ASIC has had some successful cases in that recently, but if that link can be made, then your assets are at risk, and that doesn't matter whether it's the tax department or employees or anything. That's all the same. I mean, the tax department does rank higher than some creditors, but it has no other rights than other creditors for chasing your personal assets, unless it can show that you breach your director's duties.
A lot of businesses will ask for a director's guarantee if they're giving you credit anyway.
Well, that's another, yeah. And then that means you are linked. That means you're bound because that's out.
So before they'll even give you credit, you have to sign a director's guarantee.
Yeah, so you need to be very careful about that and decide whether that's what you want to do.
Just cross it out.
What was that, sorry?
You don't want to find a director's guarantee, just cross it out.
Well, then they might just say, well, I'm not giving you the money. Yeah, it doesn't actually work. You know, in practice, sounds good.
One last question. Right, we're all good? Mr. David French, thank you very much. Thank you for sharing your expertise and knowledge. We have something for you.